If you are an investor, and if you have any interest in the future of your money, we all do, right? There's really only one topic of conversation right now. It's not NFTs, it's not crypto or anything like that. It is inflation. Now, why is this on everyone's minds right now? What does it actually mean? And what, if anything, do you as an investor need to do about it? Let's dig into this a little bit. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based here in the UK, and I've been putting up videos on YouTube for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. Now, I've been investing on behalf of myself and of my clients for more than 20 years. And in that time, we've seen some levels of inflation very similar to where we're at right now. So what is currently going on is not unprecedented, despite what you might read in the press. And because of that, we can learn from the past. So what is inflation? Well, most people watching this will know what inflation is, so let me keep this very simple and quick. Inflation is the increase in prices over time. So if something costs more now than it did 5 years ago, say, that's inflation. And at a national level, inflation is defined by measuring the cost of a representative basket of goods and services every month. Here in the UK, there are 720 different goods and services that are measured by obtaining 180,000 separate price quotations in 140 locations in the UK. And all those prices are aggregated to give an index figure. The difference between that figure this month versus the same month a year ago, that difference is the inflation figure. Now, the main inflation measure here in the UK is the Consumer Price Index, or CPI. And to the end of December 2021, which is the most recent figure as I record this, CPI is running at 5.4%. Now, a year ago, it was just 0.6%. So that's a 9-fold increase in the rate of inflation over the course of a year. And that's why you're hearing about inflation everywhere right now. It's important to remember that this is a 1-year rolling figure, right? It shows the increase in prices compared with a year ago. Now, the consensus in the market seems to be that inflation will fall back to something like normal, whatever that means, something like normal levels over the next year or two, but that going forward, we are likely to be living in a slightly higher inflationary world than we've been used to. So how does all this impact your investments? Well, if prices are rising, it has an impact on us all. So right now, it's pretty clear energy costs are going through the roof. So if you pay for your own electricity, gas and all that, you're going to be feeling the impact of higher inflation right where it hurts, in your pocket. You're going to be spending more of your monthly pay on fuel and lots of other stuff as well, which are going up in price. Now, as investors, if we really distill why it is that we are investing, we are choosing not to spend everything we have right now, and instead we are setting aside money for future use. Now, obviously, we want that money to be worth more in the future than it is now. And for that to be the case, we need to beat inflation over time. So that is why, with interest rates so low, we don't leave cash in the bank. Doing so would guarantee that the buying power of that money in the bank will be reduced over time, because inflation is running at a much higher level than bank interest rates. So we invest to beat inflation. That's kind of the whole point. Now, if inflation means that the value of money is eroded over time, this tends to impact bonds and also growth stocks. And you will hold those in your portfolio if you're a blended balanced investor. More on that in a minute. So why are those things impacted? Well, let's think it through. A bond is a loan made by the investor to either a company or to a government. And a large element of the value of those investments is tied up in the future income that is produced by them. And because in most cases that income is fixed, inflation erodes the value of that future income. So bonds with long timescales tend to be affected because inflation has time to act negatively on those future returns. Growth stocks, similarly, are companies where the bulk of the returns, and particularly the dividends that are going to be hopefully produced by those companies, it's all expected to be in the future. And again, that future return will be eroded by inflation. So growth stocks tend to suffer when investors are worried about inflation. By the way, if you're interested in a bit more detail about how all this works, I'm going to put a link in the description to a brilliant video by my friend James Shack. If you haven't already, definitely watch that one after you finish watching this one. So if bonds and growth stocks are likely to be impacted by inflation, because they usually are, surely it makes sense to sell out of them, doesn't it? Well, no. Now hear me out here. If you came to this video for confirmation that you should be doing something, anything, to try and mitigate the impact of inflation on your investments, I'm actually going to tell you to do nothing, but I am going to explain why. So here's a chart of the FTSE All-Share Index over the last 20 years to the end of December 2021. Only using this as an example, and yes, you should invest globally, but it's a bit disingenuous to talk about UK inflation versus global equities. So for the purposes of driving the point home here, I'm just going to stick to the UK. Now you can see that the UK stock market has dropped significantly at various points. We've got the tail end of the tech sell-off where markets tanked over 3 years. We have the great financial crisis of 2007 to 9. Markets fell across the world, some by 50%. And we really were on the brink of a meltdown of the system. And of course, more recently, we had the sell-off around the COVID-19 pandemic when we really didn't know what the outcome might be. Now let me overlay a chart of how UK gilts have done over the same period. And a gilt is just a bond where the borrower is the UK government. In the US, these would be called treasuries or T-bills. And you can see that when equity markets have suffered, bonds have generally held up pretty well. And that's why most of us hold bonds to some degree. They act as a volatility mitigator against the equities that we hold. And so if you try to sell out of your bonds to try and beat inflation, you're going to fall prey to that classic investor mistake, which is trying to time the market. You'll sell out of bonds. Maybe you'll even try and sell out the growth element of your share portfolio. But all you'll end up doing is increasing the risk of your portfolio. You're making short-term decisions based on what you perceive is going on in the world. Now, there is a reason why I bang on all the time about tracking markets and holding a multi-asset portfolio. If you track share markets, you will hold growth stocks for sure. But you will also hold loads of value stocks. You'll hold stocks that have really strong dividend flows in the here and now. And those will likely benefit from a rise in inflation. So instead of trying to choose the winning stocks or sectors, if you track the market, you own all the stocks. Some will win right now, some will lose. A few months or years down the line, different stocks will win or lose. But overall, you will head upwards over time if history is anything to go by. Likewise with bonds. I mean, bonds are an even broader church than equities. So you've got investment grade and high yield bonds, developed market and emerging market bonds, index linked bonds, tons of other kinds of bonds. If you hold a bond index tracker, you'll hold all of these. Some will win, some will lose, just the same as equities, but overall you'll head upwards over time. Now, by blending a portfolio, you will get the growth of the equities with the volatility mitigation of the bonds. Let me just overlay a 50-50 UK share and UK gilt portfolio onto our performance chart. This portfolio is rebalanced once a year. And you can see that when things are going south, the bonds keep things bearable. But when things are going up, you participate in that. Maybe not to the same degree as if you held pure equities, but you do still get the benefit, and you certainly don't get as much of the downside. Diversification takes the edge off the falls without hamstringing the growth completely. And you can adjust the blend of equities and bonds depending on your risk tolerance and your time scale. Generally, over longer time scales, you want to have more equities because that's where the growth is. So am I being too simplistic here? Well, maybe, but that is absolutely the beauty of this. Holding everything by tracking markets instead of trying to choose what to hold at any given time removes a boatload of pressure on you as an investor. It removes the pressure to do something when every other video on YouTube is telling you to sell bonds and buy gold. If you are a buy and hold, long-term, market tracking, passive investor like I suggest you should be, you actually get to spend your time doing something constructive like regrouting the bathroom instead of wasting time trying to beat the markets, which you will almost certainly fail to do. By blending investments, you'll get the highs and the lows ironed out to some extent. That leads to peace of mind, being much less likely to panic and then snap and then do something stupid like bailing out when the market is at its lowest. Folks, you cannot consistently beat the markets. People way smarter than you and me, they try it and they fail all the time, even those who are paid megabucks to try and do it. Now we all know, past performance is no guide to future performance. It is conceivable, maybe, that we're heading for an economic environment the likes of which we've never seen before. I mean, anything is possible, but I doubt it. We have experienced inflation like this before, and we are still here to tell the tale. Those of us who just stayed invested are significantly better off than we were back then. The current concern over inflation is just the latest in an endless line of so-called reasons why you should do something with your investments. My suggestion to you is that instead, you should do absolutely nothing. Just hold the line, hold your nerve, and wait and see what happens. Okay, folks, I hope it's given you some peace of mind amongst the noise. I know plenty of you will disagree with me. That's fine. I've been doing this a long time. I'm more convinced than I've ever been that this is the way to invest for the longer term. But if it's been useful, hit the like button, subscribe to the channel, leave me a comment if you've got something to say. I will try and respond to as many as I can. Thank you so much for watching, and I'll see you in the next video.